Hey, peace family, and welcome to another episode of Ask Jay. Me, phone, and the plant, and you, the questions. Let's get it in. All right, so I really appreciate you guys engaging with our team and asking such great questions. Let's talk about, Carlin McKenna, and I'm in need of some advice. My friend Dennis McNeil closely follows you and suggests that I reach out to you. I'm a fellow investor that ended up picking a bad business partner to find my first deal. I was thinking of filing bankruptcy, but my attorney mentioned me losing my home, not happening. Plus, I'm doing well with Airbnb with this property. Any way I can speak to you one-on-one just for your guidance. All right, guys, very sensitive situation. If you're doing well in other businesses, but one goes bad, can't file bankruptcy because bankruptcy is for all your assets. So to this person, I'll have my team reach back out. I think it's Carlin, and I've really suspended one-on-one consultations, but on the strength of, I don't know if it's Dennis or Denise, on the strength, I'll see what I can do, right? But for our general mentorship for the rest of you guys, click the link below, and we do have mentorship opportunities, coaching opportunities for you. But I just have protected my time and I don't do many or really any one-on-ones currently. How can I develop a mobile home community? That's a good one. It's something I've actually been looking at with my family. First and foremost, you need to buy land that is in a zoning that is acceptable of mobile homes, right? And you want to be in a township or municipality, community that mobile homes are desirable because you obviously want tenants and you want customers to either buy or rent the mobile home. Then from there, you'll find out the specs. How many mobile homes can you fit on a particular lot or whatever the lot size is, and you'll start going down all the development due diligence, right? From environmentals, setbacks, all of that. You get an architect, engineer, right? And you're literally a full-blown developer at that point. Anyone that's asking a question like, how do I develop a mobile home community? You're basically saying, how do I become a real estate developer? You must get some kind of training. God, I'll be just lying to you all and just being like a YouTuber to make you think that you could just become a developer overnight just by watching YouTube videos and getting somebody's free Ask Jay advice. You literally, I'm not saying with me, but you literally got to get with somebody and get some real coaching and training on real estate development because there's just too many intricacies from your civil engineering to your environmentals to your surveys, to your build costs, to your soft costs, to your financing costs, getting financing, to your financial pro forma, your financial model, to see what projections are on the property. It's just a lot, and it's just not something you just stumble into. It takes real dedicated study and expertise, but it's doable. How do I pay off a mortgage fast? The simplest way to pay off a mortgage faster is to make any extra payment that you can make, weekly, monthly, bi-monthly, yearly, whatever. Always write a note in your payments to make sure the payments go towards the principal balance. If you just pay your mortgage off and you add extra money to your mortgage statement or mortgage payment, bank is gonna process that and put majority of the money towards the interest payment, which is how they get paid. And most mortgages are like you pay mostly interest on a 30-year mortgage for the first 21 years. It's mostly interest more than principal. So if you just pay it extra, you're gonna be paying a lot of interest extra, getting a bank richer, but it won't affect your principal balance you owe them. So put that note in saying that it must go towards my principal. How much to offer on a house that is below asking price? That's subjective. How motivated is the seller? How much competition is there for the property? If there's heavy competition, then you may want to come in with what the seller wants, right? And it also depends what's your goals for the property. Whenever you negotiate or make an offer, your personal preferences matter. Is it for you to live in and is dire need for you? And if it's for you to live in, but you don't really care because you're living somewhere good already, is it for you to live in, but you got your house right now, or you already sold your home, or you're renting and just dying to own a home? Is it a flip property for you? Is it a long-term rental property for you? And if so, how bad do you want it is the end of the day. If there's demand and you want a property bad, you have to go in high, aggressive, or attractive. If there's no demand and you want a property badly, then you might be able to steal off, even negotiate lower than what they're asking because you're not worried about losing it because there's not too much demand. But now you can be too aggressive. So this is what I always ask myself is when I make this offer, if the person turns my offer down and somebody comes in over the weekend and swoops this offer, will I feel sick on Monday? That's how I really ask myself, like, if you're gonna be sick in your stomach because you lose this deal, then stop playing and get the deal, as long as it makes sense. If you're not gonna be sick and you don't really care if you get it or not, then be aggressive in your offer and lowball, because you don't really care, especially if there's no demand. So that's how I approach negotiations, but don't play negotiator and end up losing a great deal that you wish you had and regret it on Monday. How much of the sales price do I get once the property is sold? If you own a property and you're selling a property, once you sell it, you get all the revenue after commissions are paid to a real estate agent, if you have one. Closing costs are paid, which are any title or closing attorney or closing agent's fees, prorated taxes that might have to be paid forward, any water bills, anything that's owed. Yeah, and after that, and what you owe the mortgage company. If you have a mortgage, you got to pay the mortgage company off. After everyone gets paid, closing costs, realtor, mortgage company, you then receive your net profit. And if it's an investment property, you then have to worry about Uncle Sam. And if you guys click the link in this video below, you'll see some referrals for actually tax strategists, tax advisors, and folks you can go to help you with your tax needs, right? To mitigate your tax liability. If you're an owner occupant of the property, as an individual, you can actually earn up to $250,000 without paying any taxes on it, as long as you live there. And as a couple, I believe it's $550,000 you can earn on a property without paying any taxes, capital gains taxes. What to look for when investing in a real estate? What makes a great investment? A great investment is particular to the individual and your goals and your needs and where you're at in life. And I hate to say general answers like that because I want to give you something juicy, but it's different to everybody. Some folks, a great investment is I just want to make 10% a year. Some folks want to make 21% a year. Some folks don't even care about percent. They just want $1,000 cash flow every month. Some folks want to make a $10,000, $20,000, $30,000 flip. It just depends what you want to make impacts your life based on your goals is what's a good investment. I typically like to say if the money is making more money for you than what it's making you, your money sitting in the bank, it's therefore greater opportunity cost to your money. How can you leverage the combined income of family members to do a deal on a multifamily? It's very, very simple. You get the application, and in the application it's going to say borrower, and then it's going to say co-borrower. But guess what? They can give you another application that says co-borrower, and another one that says co-borrower, and you would have a key borrower and you have multiple co-borrowers all on one loan. And the bank will actually take the total sum of everyone's income, but also everyone's debt. Which is more beneficial for someone who wants to get into real estate? Starting off as a realtor, starting off as an investor, what are the pros and cons? Becoming a real estate agent or realtor is being a broker and getting paid a commission for being in between transactions, either representing the seller of the transaction or representing the buyer of the transaction. And you get a fee. Or you can represent both. Be a dual agent, paid from the buyer and the seller. Well, you're paid from the seller, but you're paid representing both. The seller always pays the commission. Buyer doesn't pay the commission. I've done it for 9 years earlier in my career. And you can make money, but you'll also be working for others, and your check, your income, your revenue is going to be subject to them actually closing or actually selling and not firing you in the process or not changing their mind in the process. As a real estate investor, your destiny is more in your own hand. Either way, you got to learn the business, learn the industry. Real estate agent school does not teach you how to be an investor. If you want to be an investor, you must go to somewhere like the Morrison Academy and learn how to be a real estate investor specifically. Cool part about real estate investing is you have multiple ways to real estate invest. You have wholesaling, which includes assignment of contracts or double closing or same day flip. You have landlording, simply getting rental properties, house hacking, or any of that. You have flipping, good old fashioned buy low, sell high, and you have that opportunity. You have buying notes, buying short sales, buying foreclosures. You have new construction and building. You have mobile homes. You have lot development and subdivisions. There's so many areas and ways that you can earn and you can eat. Cool part about being an investor is that as long as you're the brains of the operation, you can always bring in cash partners, credit partners, management partners, experienced partners, deal finders, coaches. And that's how we teach the business, is showing you how to be the go-to person in your sphere of influence and taking that influence and going out to transact and make big money in real estate. Someone said, when married and purchasing first home, should we both put the property in our name or not? I I'd say you sometimes can get more buying power by having one person on a loan and the other not. But this won't help you for owner-occupied purchases. You can't go lie to the bank and say, hey, I live here, but I'm married and my husband lives over there, and we're both gonna be owner-occupied purchasers and put 3% down. That's not gonna work, and that's fraud. But you can, from an investment standpoint, only have one loan show up on one of your credit reports, therefore only changing the debt-to-income ratio of one of you. So there's no point, if you don't have to, putting both of you guys on a property and having both of your debt-to-income affected when you can just have one debt-to-income affected and the other one be have a lower debt-to-income ratio, which gives you more buying power, future endeavors, loans, lines of credit, and all that good stuff. What else do we got? Oh, real estate tax strategies. Okay, so here's the cool part about real estate and taxes for everybody, whether you're a wage earner, 1099, whatever. It's that the mortgage interest is tax deductible, depreciation of the asset is tax deductible, maintenance, property management, anything you spend on your investment property is tax deductible. If you have a multi-unit, the units that are investment units, you can deduct so many things versus your primary unit. You also can have a home office and proration of square footage in your house, that's for your business, that's also tax deductible. Landscaping and other things for your investment property is, plus a fancy word called cost segregation, which allows you to depreciate personal tangible property over a series of years. All these things you guys can also get game on by clicking the link in my bio or below. I have a tax consultant, my personal tax consultant, personal bookkeeper, my personal accountant, my personal tax strategist that I'm going to refer to you all. And it's not somebody I just found and say, hey, let's do a deal. It's actually the person that's behind the scenes in my books, organizing and reconciling our family finances, company finances, and I'm going to refer this firm to you. The link below for your opportunity to get a warm referral for King J. All right, family, this is amazing. As Jay, thank you all for tapping in with me again. This will conclude season 1 of the infamous Ask Jay. Tap in. Follow me on all channels at Mr. J Morrison. Like, subscribe, share, and comment. Peace.